Welcome back everyone to my channel. This is me, Prem Kumar. In this video and series of videos, I'll be talking about money, that is more money back into your pocket. So I'm a chartered accountant. I have been working in UK for 7 years in corporate sector. And as my income increased, my personal tax liability also increased. So I started to explore more and more about how to save more money, how to earn more, how to have less tax legally, of course, how to have those bank free benefits, for example, like free money, how to make sure your salary sacrifice arrangements give you maximum tax benefits, and then there are other cash back and a lot more. Basically, the point was to how to make sure you actually get more money than you generally if you don't know all these things. So that's what I explored, that's what I researched a lot, and that's what I use in personal life. And this video and a lot of videos I'll be making down the line, like probably at least 20, I'll talk about each and every single thing that I use to make sure I get more money back in my pocket than I would generally get if I don't know about these things. So this video is literally first in the series about pensions. There's a lot on pensions I'll be talking about, so I will hope you stay tuned till the end of this video as well as end of this series. Before getting into details of pension itself, I'll just quickly talk about taxable income and how tax arises on the income. So basically in the UK, if you are working, the taxable income is combination of nothing but basic income, any additional allowances that you get, bonuses, and pension, which is what we'll talk about that later today. And if you are somebody who's more of a real estate or somebody else, any other income that can be counted as taxable income. And the tax arises in bands, so it's a progressive tax structure. There's certain personal allowance at the start whereby you pay no tax, and then you pay 20% tax, and then for any additional income you pay 40% tax. And once you start earning quite a lot, and we'll talk about that, you start paying 45% income tax as well. So it's progressive in nature. You don't pay flat 40% of your whole income. You pay based on the progressive bands in terms of how much you earn within that band. So that's more for taxable structure. Now let's deep dive into pensions. So the pensions is definitely one of the hot topics among higher earners, especially with people who are earning more than £100,000 because they want to avoid the 60% tax trap. But nonetheless, also very relevant for the people who are earning less amounts, because part of it is the free money from employer as well. And we'll talk about everything. So in this video, I'll be talking the pensions in the angle of pension growth, and then the contribution, the tax side of it, and then the legal side of it, and how you can actually benefit from the whole scheme. So the first thing, legal side of it, your employer is mandatory, required by law to auto enroll you into pension scheme by default. It's not a choice to them. They have to enroll you if you're earning at least £10,000 per year as of now, of course. So they have to enroll you, but you can of course opt out of it if you want to. There's a choice I did made for first year, but if you want to, you can opt out of it. If you opted out of the pension, they have to mandatory again enroll you after 3 years. So it's a legal requirement they have to follow. They cannot avoid that. Now, what happens is by law, they are mandatorily required to contribute to your pension, and there'll be some deduction from your amount as well, your salary as well. So unless you've opted out, the law mandates at least 8% of the salary to be the total contribution in the pension fund, which is minimum 3% for the employer, and the rest can be borne by employees. So that's minimum, but in reality, a lot of employers actually pay up to 4 or 5 times as well. I have seen employers paying 5% employer 20%, so 25% is going to pension. Those are real numbers. So it's just law mandates you to have a minimum percentage, but in reality, some employers are quite generous in these policies. They pay a lot more money in your pension fund. So that's the legal requirement of it. That's something that every employer has to follow as long as you're earning about £10,000. Next thing is how it works out in terms of your salary and how it gives you tax benefit really. So what happens is if you're earning, for example, 50,000, and I'll talk about a proper example later, and I'll show you some numbers as well. But if you're earning 50,000 taxable income, your tax is calculated on 50,000. But now if you are contributing as an employee contribution 5,000 to pension allowance, then your taxable income is 45,000, it's not 50,000. So you are actually reducing your taxable income by quite a chunky amount, because from 45,000 to 50,000 you are in 40% tax threshold. So basically your additional tax liability savings that you had is based on 40% and not 20%. So you actually get quite a decent benefit in terms of pension. So by doing this, you actually save 40% on a tax liability of the amount that you put in the pension fund. But then there are of course more questions, can I access that amount? When can I access this amount? What are the tax implications about retirement, and a lot more of the questions we'll be covering about that. But just giving in context, this is how it actually reduces your tax liability year on year. And of course, it's your money that goes into fund like fully. It's to employ free money that's going to the pension fund, and then of course there's a lot of growth in the pension fund as well due to the investment. So that's our next topic in terms of how money grows in the pension funds. So in terms of pension funds, what commonly happens is your employer paid some money in your pension fund, you had some money deducted from your salary, and that went to pension fund. Take an example of you paid £500 from your salary, your employer paid £500 additional, so £1,000 went into your pension fund. Basically, In terms of take home amount right now, of course, you'll be having less amount than if you would have opted out of pensions, because what happens is pension, you have a deduction of 5,000 from your salary, and then of course there's a benefit of, for example, 40%, there's a benefit of 2,000. So over the year, you are actually having 3,000 less take home, right? So you're thinking of why to even go about that route, why to actually reduce my net take home for every single period. But what happens really is when you invested in the pension fund, your employer contributed 5,000, you contribute 5,000, you took the hit in current net take home, but the 10,000 per year invested for maybe 40, 50 years, and then assuming a growth of 10% on average, because these funds actually invest generally in money market securities and then investment funds, investment growth funds. So generally assuming it average growth of 10% based on S&P 500, or actually S&P 500 is more actually, but that money can be really chunky. It can be in thousands or maybe in millions as well if you're earning quite a lot of money. And that money at the retirement, which is I think 55 or maybe increasing to 57 in UK for private pensions, you can take 25% out of it completely tax free. There's a limit of like 250,000. You can take 250,000 at that point of time completely tax free from your pensions. And what people generally do is use that money to clear off their mortgages, any other debt, etc. they have. And any remaining money, your pension funds, by the retirement time, you can actually treat as a sort of income. If you take maybe 12,000 pounds per year from the pension fund, which is below the personal allowance, you're not going to pay any tax on that. So definitely there's some hit on net take home right now for foreseeable months. But what happened is you are getting a lot of free money from employer, assuming 5,000 per year, and I'm not even increasing the salary or any increase. For 40 years of employment, you're actually getting 5,000 to 40, 200,000 free from your employer, put into pension funds, which are growing at least 10%, of course, on compounding, So definitely looking at large sum of money in your pension pot that we, set you for retirement. Then the other questions come, why to actually go for pension? Maybe I'm an immigrant in the UK, I'm also an immigrant, why to actually get a pension if I am not going to live in UK until retirement? So there are, of course, options, if you leave the UK before retirement, your money can be here in the funds, it can be invested. If you want to keep, it won't have any employer contributions or contributions, but it can grow, right? It can be invested, it can grow, or you can probably transfer as well if there are opportunities, options available. So it's not like there's an deterrent in terms of investing now if you want to leave the UK in future. Just before getting more into numbers in terms of how it can work out in terms of specifics, just to highlight, the pension cannot be touched in UK until you retire. So it's not something that you can take out early. It's something that can be only taken out at retirement. And another common sense thing, of course, there are always beneficiaries in the pension scheme, just in case if you had any, death or something, so your beneficiary can avail that. So it's not like if you're gone, that pension is gone, right? So that's not the case. I just want to highlight that thing before we actually have a look on the example in terms of how it can work out from your tax perspective. Sorry for the laptop here, just to make sure I give the right numbers. So in UK, if you don't take the pensions, you opt out of it, then basically if you are earning a salary of maybe 62,570 pounds per year, out of that 12,570 is your personal allowance. So what means is you are left with 50,000 taxable income here, which will be taxed at 20% first and then 40%. So what happens is out of that income from 12,571 to 50,270, you'll be taxed at 20%, which leads to tax of 7,540 pounds, and then from the 50,271 to the your salary amount, you'll be taxed at 40%, which leads to tax of 4,920. So basically, after deduction of NI and everything, you are getting 46,848 pounds if you opt out of your pensions completely. So that's the amount you get. But now if you're going for pensions, you basically, for example, pay 5% pension, 5% your employer. So what happens in that case is your pension contribution is 3,128.5 pounds, which is, as I mentioned, deducted from your gross salary before any tax applied, right? So now what happens is your 20% tax band remains exactly as it was, 7,540, but now there's less salary, less taxable income, your 40% band, which now reduces your 40% tax band liability to 3,665. So, and the net amount you receive is 44,970.5. So what happened here is by deduction of the pension, you actually have less 1,874 pounds per year in your pocket, whereas you contributed 3,128.5 pounds in pension fund. And also your employer would have contributed at least this, or maybe 3, 4, 5 times, does matter on your employer. So you will be having deductions, yes, If you think of dividing by 12 and dividing by per day, you'll be seeing a very minimal amount, right? That 3,128.5 multiplied by 2, because your employer also contributes at least similar amount. That's 6,000, and that can go into fund every single year, and that will be invested, and you can be looking at like millions literally when you reach the pension. So that's literally the reason people put a lot of money in pensions, because it helps with the retirement planning. Really, they have a lot of money for themselves. In UK, of course, it's not like you rely on your children to feed you, for example, and make sure you are looked after. You basically have all your own pots of money that you get on retirement from your private pensions generally, that you look after yourself, and you can have a very stable life. The other thing, important thing to highlight is it's not just a mandatory contribution, right? If somebody is earning above £100,000, they essentially get a tax trap of 60%. I did make a video about that if you want to watch. So people would want to avoid that, and they actually have a salary sacrifice arrangement with the employer, whereby they want to sacrifice part of their salary for pensions. So it's just a way of technical way of tax efficient way of making sure you actually end up having taxable income less than 100,000. So in that means there's a lot of focus on pensions. So that's basically, in top earners, people pay a lot of money actually into their pensions. It can be 10, 15, 20,000 pounds minimum per year, because they would want to avoid 100,000 tax trap here, and by reducing the taxable income. Hopefully this helps and gives you perspective of why pension is important. Of course, the first year I had no idea and did not do a lot of research in terms of why pension is better, and I did opt out of it, unfortunately. But after that, I definitely opted in back and made sure to invest in the right funds, because in my employer I got a choice of where my pension is invested. Of course, as allowed my employer, but it just gives me a choice of, do you want a growth fund, do you want more of a stable, like money markets with government securities, do you want real estate? So there's a lot of funds I was given option, and you can definitely choose based on your own requirement. Hopefully this helps, and thanks so much for watching, and definitely stay tuned for a lot more videos on these.